Tyler, Delta Airlines stock is down some 40% so far this year from the high that it reached earlier this year, and essentially has erased more than half of the gains that it made from since the pandemic back in 2020. And I know that that decline, that big percentage off the high that we're seeing, has got a lot of investors looking at it and thinking that it's compelling. But we want to lay out the risks right now for Delta and maybe talk about a stock that might be a better buy right now too. Tyler, let's break down what's going on with Delta.
We could expand. We're focusing on Delta here, but let's be honest, we can probably expand this to all airlines.
Yeah, all the domestic U.S. carriers, particularly the ones that have international exposure like Delta. There's a lot of reasons to be concerned. Before we get into it, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, look on the screen. You see that link, fool.com/unscripted. Go check out that link. You can get access to The Motley Fool's 10 best stocks to buy right now. Definitely go check that out. All right, so let's just start with going back a week or so here when Delta reported its March quarterly results. And I mean, the results were fine. Let's start there. Operating margin, operating results were fine. Everything came in pretty much within expectations. Their guidance for the coming quarter is a wide range. I think that's important, from down 2% to up 2%. Again, I'm still expecting pretty solid earnings and pretty decent margins. But the bigger story, and I think this is what we want to highlight with Delta and its peers, is the market's always looking forward, Tyler. So what's going on right now that really investors should be really conscious about before just buying the dip on Delta?
Yeah. Well, let's put it a little bit of context into this too, because I think one of the things when people look at airlines is, for the past, it seems like for a long time now, shares of airline companies have always been really cheap. We're talking like single digit price to earnings ratio sort of valuations, and seemingly priced like things are going to go spectacularly wrong. And it's always been the theory for a lot of these. Well, it can't get any worse, right? And there's a lot of safety baked into this price of, like, right now, Delta trades, I know it's down 40%, but it's trading for 7.3 times earnings. In a vacuum, you're like, that's a pretty low bar at 7 times earnings. Certainly, a lot of companies you and I look at are at 7 times earnings and they look attractive. But
Yeah.
a couple of things that they've been talking about, the second quarter guidance looks okay for Delta, but if you looked at it, it's like they are reducing its capacity for the second half of the year, and their full year guidance is looking pretty shaky. In large part because if you look at booking trends for international travel coming into the United States, it's down significantly. And for Delta Airlines, which is one of the biggest international flight carriers we have in the United States, compared to, I think it's like them, United, and to a lesser degree American, because of flights to Europe and flights to Asia and things like that. And so as a result, what is expected to be a significant decline. For airlines, a 6, 7, 8% decline in seating is massive. You have to have butts and seats for this business to work well. High capacity of all of your flights, and being able to maintain a schedule on a certain pace to keep these things flying at a very steady pace. And with the declines that they're talking about on an international travel level, that's going to significantly compromise what's going on here in terms of second half of the year trying to right size its capacity. And that can mean like less frequent flying, less planes in the air. I know airplanes and manufacturing are very different, but it's the same thing. If you have idle capacity, those are vampire assets. They're just sucking the operating income away and not really contributing in any meaningful way. And so with Delta Airlines, United, and things like that, with heavy exposure to international travel, we could see the second half of the year, we could see some pretty sharp reversals in income for these companies that it will be hard to recover from. And this, I think, gets to something that you and I don't know if we've talked about much here, but we certainly have talked about it offline, is what makes airlines so challenging is that it seems like every, 7 to 10 years,
Something happens.
It was just before 2020. I want to say like 2018, 2017. I can't remember the specific dates, but Berkshire Hathaway started buying airlines. And this was like an industry that Jason, like Buffett had.
We have to remember Warren Buffett, one of Warren Buffett's most famous quotes was saying that investors would have been served well if someone had have shot down Orville and Wilbur Wright.
Yeah.
Right.
He for years, he trashed the industry as basically like a place that capital goes to die.
Yeah.
And so when when Berkshire Hathaway started buying airlines during the late 2010s, it was a sharp reversal in what We did. And it was the thinking was is like, well, they came out of the financial crisis. A lot of them right-sized their balance sheets. They had found religion in terms of capacity and not just
Mhm.
trying to grow revenue, but trying to like make their routes as efficient as possible. And it seemed like they had found religion on returns. And
Well, there was so much
even if they was
consolidation
good,
too. The industry had consolidated so much that makes it easier for everybody to be profitable when there's less competition.
yeah. So less competition, less pricing, all of that. It all seemed to like, if you squinted hard enough, you could look past like decades of not profitable operations and seen this and be like, okay, well, it's working. Well, and then the pandemic happened. And so, and obviously they ran into major issues, shut down flights, took on a bunch of debt, trying to right size the balance sheets. And the same thing from the pandemic to probably the end of 2024, it was just the epic struggle to right size the balance sheet again, right size capacity, get everything up, up, up. Okay, we're going good again. And then bam, we see inter-country tension translating into lower international travel into the United States. And so I know it looks bad to say this, but it really does reinforce the point that you and I have said for a long time is don't get tempted into buying airlines because it just seems like no matter what happens, something always seems to be around the corner that makes these businesses so challenged and there's a reason that they trade for these single digit earnings for almost any given time.
Yeah, no, that's right. I want to give Delta a little bit of the benefit of the doubt. Delta has turned into probably one of the two best operators in the space. They've done some good things. They have paid off a tremendous amount of the debt that they took on during the pandemic just to make ends meet. So they've done those things. And this price could work out, but there's so much unknown and variability there that I think Tyler's right. It's, broadly, I think there are better ideas right now. So with that in mind, Tyler, what's a better idea if you want to get exposure to aerospace or airlines? What's a stock do you think would be a better buy right now?
Well, it's such a challenging space in general, but if I suppliers, things like that, Boeing isn't exactly firing on all cylinders either. If I had to go into the airline space, I would look for some of the parts suppliers, aftermarket parts servicers, and companies that have a lot of exposure to aftermarket parts and service. So GE Aerospace, I think, would be a relatively interesting way to look at this industry. You have a large fleet of GE engines out in the world today, many of which are quite old and require significant refurbishing and maintenance and keeping online for a long time. The like the 76, what is it, the 777, not the new one that Boeing would propose, but the old legacy one that's been flying for decades. They're one of the exclusive engine providers for that. And that looks like it's going to be continuing to fly for a long time. You have the LEAP engine, which is the exclusive engine on the 737 and on the Boeing, or sorry, on the Airbus A320neo. That is expected to be the largest used engine in the world by 2030. And as these things get serviced, which is the high margin portion.
Right. That's the thing. They actually make better margin on the services revenue than they do on the engines themselves. So it's a really compelling position to be in, to be seeing your inventory in the field get built up, which is going to give you a less cyclical, more steady, higher margin source of revenue.
Yeah. I don't want to call it an annuity payment because you actually have to do something for that money, but it's a lasting payment over a long term that's going to generate revenue for decades. And something like this that doesn't require continuous right sizing of your fleet and a lot of debt to do that, I think it's just a much more attractive option than trying to actually manage a commercial airliner yourself.